Welcome to Improving Cash Flow, part of the MyCloud MBA resource series. This video expands on concepts introduced in Income, Cash, and Balances and discusses common techniques to improve cash flow and net income, as well as several to avoid. As explained in our previous video, income and cash are not the same. A business can generate $100,000 in gross revenue, net $33,000 in income, but generate no cash. While technically profitable, a business can have no cash to pay its bills and ultimately fail as an ongoing concern. A business generates cash primarily from ongoing operations, with investments and financing providing the rest. And to understand the complete financial picture, owners typically use three key business health reports: the income statement, the cash flow statement, and the balance sheet. Our hypothetical business used the most common source of cash outside of operations. They finance their accounts receivable. While extending credit is often rewarded by a sale, marginal customers may never pay their invoices, thereby risking an unpaid debt. Businesses often sell their accounts receivables at less than face value as a non-recourse sale, thereby transferring the non-payment risk to others. In many respects, accepting credit cards is similar to selling accounts receivable at a discount. The business receives cash, but the debt belongs to the issuing bank. Depending on the product, credit cards can also generate the additional benefits of encouraging larger customer sales. Offering cash discounts is a less expensive method to encourage immediate payments and improve cash flow, but customers may take the discount and still pay late. Risk can be minimized by negotiating to take discounts on subsequent sales rather than automatically on current invoices. Selling unused equipment or slow-moving inventory is the quickest way to generate a one-time cash infusion. Unfortunately, psychological obstacles to realizing a decline in market value often create reluctance, but keeping non-performing assets is the same as financing their purchase. Finally, leasing equipment frequently helps improve cash flow through lower initial costs but at a higher total cost, depending on financing terms. Risks, however, are transferred to the lessor. The next methods improve cash flow via more efficient processes, but are generally more difficult to implement. Although requiring time to conduct a process analysis, as well as accurate customer, supplier, and cost data, they also prove more durable than financing alone. In addition to liquidity, they often improve operations, reduce cost, and cut expenditures. Eliminating redundant labor steps and reducing production inventory, such as promoted by lean manufacturing, creates benefits in both income and liquidity. To conduct such an examination, the business requires a step-by-step list of operational tasks, starting from the customer order through production to fulfillment and delivery. For each step, you'll need to estimate associated labor, completion times, and material cost. Starting with the most expensive step, work down the list and eliminate excess inventory, time, and physical movement, but without risking supplier disruptions. While the benefits are significant, a thorough analysis quickly becomes very complex and can discourage owners who then turn to professionals. Our resource video on process and focus provides tutorials in this area. Negotiating with vendors seems simple, but effective implementation requires careful planning. Most businesses handle purchases from suppliers as separate and standalone orders. Annual supply orders with staggered deliveries and payments, however, could create significant volume discounts. Missing volume commitments may forfeit the discount, but it's no worse than having never negotiated. Mistakenly, small businesses often reduce prices on low-volume items in order to boost sales. Steep discounting may make sense to eliminate inventory on discontinued items, but not for ongoing sales where lower prices could create unexpected losses. Depending on customer preferences, the better strategy is to raise prices, accept lower sales, but improve margins, such as products stocked exclusively for customer convenience when purchasing another, more expensive item. Furthermore, cost should not determine pricing, but rather if the business should even sell the product at all, given customer preferences and the marketplace. For more information on this topic, review our related videos on products and understanding margins. Financing receivables, inventory, and equipment are accepted business practices, as those short-term cash deficits are repaid over time either by customers or through operations. Unfortunately, Many businesses think they're financing short-term cash needs, when in reality, they're funding permanent operating losses. This dangerous situation typically occurs when management doesn't know their margins, misdiagnoses their profitability, then blames cash flow symptoms on customers. Instead of solving a short-term cash problem, they end up funding losses and dig an unclimbable insolvency hole. Checkbook management, or operating exclusively on available cash, is a classic business-of-business problem. Financing operational losses only makes sense as part of a comprehensive turnaround plan to improve margins where losses will ultimately be offset by forecasted future profits. In summary, make sure you create, understand, and use your financial health reports. Using loans and similar instruments to finance accounts receivable or purchase equipment is a common and accepted method to improve cash flow. Using these same methods to finance operational losses, however, is a very bad business decision. Improving operations by eliminating process steps, reducing time between steps, and minimizing inventory not only improves cash flow, but may also increase gross margins. Similarly, improvements in front office and fixed expenses will increase operational margins. Depending on your market and customer preferences, raising prices, lowering sales, but increasing margins can be a good business strategy. This concludes our Improving Cash Flow video. The contents of this video are the opinions and property of Expertine.